risk lurking. There are also upside risks, right? What if we don't end up having a recession? I think that's something else, that comes up in a lot of my meetings. So there are risks on both sides.
Risks on both sides, and look, it certainly is reflected in the 2-year. I was talking to Alex at the top of the show that is now at its highest level of the year, but there's that disconnect that's been talked a lot between that and equities. Mike Wilson, writing about it, of Morgan Stanley, yet again saying that equities don't reflect reality. Do you think that's right? We're disconnected from reality in equity markets?
I think that equity markets probably don't reflect the reality that he sees coming. And, I think that's an appropriate thing to worry about. However, I think the reality that equity markets are digesting right now is that we are really starting this economic rough patch. So we saw a lot of companies last week, particularly in the tech space, talk about how they are starting to see signs of slowing. But at the same time, in guidance discussions, we saw a lot of companies say, well, we think recovery is going to happen at this point in time, or we think we're going to weather this storm pretty well. So I think there's a reality that CEOs, I think there's a reality that investors have in their minds, and I think that is probably reflected accurately in stock prices right now. Now, whether or not that interpretation of reality changes is a different question.
Okay, so does it? Does that interpretation change, Lori? I mean, part of what was driving the rally was short covering, you could argue, and also the low quality stocks. Like, something's got to give.
Yeah, so I really do push back and I was talking to my derivative sales team about this last week, because I guess they were getting a lot of questions from their conversations about, the kind of junk is running, that means this thing has to fall apart. And look, I'm really not sympathetic to that argument at all. One of the things we published in our piece this morning is just, if you go back and you look at whenever equity markets are coming off of their mid-recession lows, it might not be precisely at those lows, but around the recovery, you do tend to see the junk run, whether you're looking in Russell 1000, Russell 2000, negative earners, highly shorted stocks, highly leveraged stocks, whatever, kind of your version of low quality is, and we hear a lot about this, that is what tends to do well when markets are finally embarking on the recovery trade. And I've been doing this over 2 decades. People always dismiss it as short covering. Sometimes those rallies do fizzle out, but they always get started with those kinds of protests being made.
If we're starting to see some of the hints at the beginning of that, Lori, and again, perhaps it does fizzle out, do you want to change your 4,100 call on this equity market? Again, if we are bumping up there and it's slightly above it at this moment, do you want to upgrade?
So look, we've said that we're comfortable with our number. I do feel like in terms of tone, my view is different from some of the more bearish strategists on the street, or even those who might have a 4,000 type number. We do see some risks lurking in the back half. That being said, we have published, and we put this out in our year ahead that we published back in November. And we said, look, if there's risk that we're being too conservative, we think the risk is more to the upside, and some of our models will push us up to around 4,500. Now, that's the kind of thing you could hit in for years, the kind of thing you could hit at the end of the year. I tell people any kind of conviction level right now, as much as we want sell-side strategists to come out with 100% certainty on things, it feels more like a 60, 70% kind of world on any call these days, so we have to stay nimble. But, I would say the 4,100, I feel neutral. I feel like there are risks on both sides, and I find myself continually pushing back against the deeply bearish view.
No, fair enough. And I love the idea that, we got 70% conviction. It is a lot of uncertainty out there. So, okay, tomorrow, 8:30, you get the number. Where is the biggest risk for the market?
So I think things have changed a bit over the past week and a half. I think that we sort of saw all year, we saw the growth sectors rallying, we saw the tech sector really doing quite well. And these areas that you would expect to do well after the final Fed rate hike were really what we're leading year to date. So we got a lot of good news around the idea of a Fed pause priced in early, and now you've started to see doubts creep in behind that. I feel like maybe the setup going into tomorrow, at least on the equity side, has gotten a little bit cautious again. So we'll see what the data shows. But I do think that if we get a favorable reading in that Fed view, that the Fed is going to be able to pause before too long comes back into play. I think there is still some room for those tech sectors or the growth sectors to run. And I would say among those 3, tech would be our favorite.
I can't help but wonder, Lori, that macro story, the driver of the CPI, does it now start to take a back seat? As you said, that we're starting to see more of a reflection in this equity market of what CEOs see as the reality. Is this the year of micro driving the equity market?
I think that's a great point, Danny. And, one of my big takeaways from talking to clients in December and January and year ahead discussions is that people are ready to move on from the Fed. They are ready to move on from inflation. They are ready to start thinking forward. And I do think some corners of the market priced in the aggressive Fed, priced in whatever we call this big R, little r recession, growth scare, whatever it ends up being. There are certain corners of the market that priced in that challenge period very early. And now that I see in these transcripts that CEOs are starting to talk about the idea of recovery and let that seep into their 2024 discussions, I think that's something investors are going to be pretty eager to latch onto as soon as they can.
Lori, I too am very eager to talk about something different than inflation, so I can absolutely sympathize. Lori, thanks so much for joining us today. Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Still ahead, hype over AI. Some market watchers are sounding an alarm over the rally in AI-related stocks. The startup is next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The native token of Binance, the largest crypto exchange, extended declines amid uncertainty over the platform's outlook. The issuer of crypto's third largest stablecoin will stop minting new tokens of its Binance-branded coin as regulators ratcheted up pressure on crypto exchanges and clamped down on the ailing digital asset sector. Bloomberg has learned that Qatari investors are set to make an offer for Manchester United in the coming days. The move would cement the country's desire to become a major player in global sports. Officials at the Sovereign Wealth Fund, the Qatar Investment Authority, are helping with preparations for a bid alongside local family offices. And Ferrari CEO Benedetto Vigna tells Bloomberg the Italian supercar manufacturer is fully on track to unveil its first fully electric vehicle in 2025.
We have a clear plan. We have a lot of competencies in the company to keep developing a car that is unique from all points of view, from aerodynamic, from performances, from design. So the electric Ferrari would be a unique Ferrari.
Vignez spoke to Bloomberg at Ferrari's headquarters in Maranello, Italy. And that is your latest business flash. Alex?
Ritika, thank you very much. It is 20 past 7 on the West Coast. Look at that picture. It looks pretty grim. That is the Bay Bridge is covered in fog. We do want to get to the startup because we want to cover the top tech stories that everyone's talking about from the Bay Area and beyond as Silicon Valley starts its very foggy morning. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. It may be dreary and gloomy, but not if you're going to be investing in AI stocks?
Yeah.
How is that segue?
It's been a bizarre 24 hours, but the kind of conversation on who's more advanced in the field of AI, China or the US, is ongoing. And what we saw overnight was just a really strange market dynamic. There's a company called Beijing Deep Glint, which is actually an AI company, but it's focused on computer vision and data analysis. And they essentially came out and said, we cannot do what ChatGPT is doing, or OpenAI is doing with ChatGPT. We cannot do what Alphabet and Microsoft are doing in terms of a conversational, generative style AI. What happened, Alex, is its shares fell 10%, sort of in this knee-jerk reaction. And by the close of play in China, they were flat. And the market's been trying to make sense of it. And I bring that up with this chart, which is the year-to-date or multi-month performance, right, of Beijing Deep Glint and its China AI rivals. And just like here in the US, everyone has been speculatively betting on these stocks in the hopes that they're going to announce something. But what happened overnight? The opposite. They announced, we cannot do this, at least not yet. And I just thought that is just brilliant in the context of what we've been covering for recent weeks.
Wait, may I just say, Alex, I think that was an excellent segue. Ed didn't answer your question. I thought it was very good.
Thank you, Danny. Thank you
okay,
for
Ed.
me.
It's okay, Ed. We'll give you another chance next time.
Sure.
Okay, look, so some questions around the hype. Ed, I do wonder if we're seeing a thing from companies, much like, for example, we saw with the hype around the cloud, the hype around crypto, where every company is starting to claim perhaps they have some sort of AI element to them?
Yeah, so I mean, Bailey Lipschultz of Bloomberg News has done some terrific writing about this. The question the market's asking itself right now is, are these AI-related stocks behaving like meme stocks? Basically herd mentality, FOMO, buying in because it's all the hype and all the range? Or is it more that FOMO angle like we saw with crypto, where everyone kind of speculatively jumped in because they didn't want to miss the boat? What's astonishing is that a lot of these companies are sort of very early stage, pre-revenue, and many of them went public via a SPAC. So Big Bear AI, C3 AI are great examples. Their year-to-date or 2-month, I can't even remember what date it is, I guess we're mid-February, 6-week performance is absolutely staggering. There you go, year-to-date on the screen. Big Bear is up more than 500%. But when we speak to venture capitalists on the Bloomberg Technology Show who are investing in this area, or we speak to AI researchers, experts in this field, they basically couldn't tell you much of what these names are doing. These are speculative bets compared to what we're seeing in the real world that Microsoft and Alphabet are putting forward.
Okay, let's go to Microsoft for a second, because the NASDAQ 100 is up 94 points, and Microsoft is accounting for like 50 points of that. What gives?
Yeah, I think that actually this is going back to basics. So after we'd had the earnings print 2 weeks ago, analysts have taken their time and said the outlook for Microsoft's software business is actually pretty decent, and that it's attractively valued. The fundamentals are strong. Ironically, when they look at the artificial intelligence component, they see the addition or the accretive benefit to the top line being pretty distant and moderate in the near term. There was so much hype last week about what Microsoft's doing with the underlying technology from OpenAI for search, but actually in the scheme of things, the sell side reaction is to say it's going to be a while till this meaningfully shows up in earnings. Everyone just chill out a bit and focus on what Microsoft's good at, which is software.
Yeah, well, to be fair, Microsoft is up 13%. How much of that is the software story? How much is the AI story? Ed, thank you so much for joining us. That's Bloomberg's Ed Ludlow. Now, coming up, it's all about U.S. CPI. The numbers there expected to show costs rising. We're going to speak with former Fed Governor Randy Kroszner. This is Bloomberg.
hour into U.S. trading session. Volume still super light, but you are having equities making a go for it. Kriti Gupta is looking at some of the moves. Kriti?
Yeah, Alex, it's really just a tech story. I mean, that's really what you're seeing here with the NASDAQ kind of outperforming by 0.8%, the S&P 500 higher by about 0.7%. It really does come down to those same names have really driven the rally year to date. Think your Microsofts, your Alphabets, your Meta. I believe Tesla is your biggest volume trade today. Apple kind of lagging just a little bit. But it's that 2-year yield that you also want to keep an eye on, because that kind of correlation where you look at bond yields higher, tech lower, it's not really functioning in the same way that I feel like we've come to know in the past year or so. And that is a really important part of the conversation when it comes to just how sustainable tech is and the growth story for the American economy as a whole. Which, speaking of the economy, let's go across the Atlantic for a moment and talk about the economy over in Europe, because this is something that's really important. You are seeing growth actually increase, and the inflation story perhaps not be just as bad as it was before. This is really important. It really kind of feeds into the Torsten Slok, quote, no landing idea over at Apollo Management. The idea that what if this recession that we've priced in all in 2022 isn't as bad as we think it is, or perhaps isn't there at all. And that's going to be something that you're going to start to see factor more and more into the market conversation, specifically after that CPI number tomorrow. It also is going to show up, I think, most easily in the dollar story, because of course, if you were looking at a global recession, a global turnaround, it's the dollar that's going to show up most. And of course, we know that you are kind of seeing a little bit of this drop, this weakness in the dollar quite a bit, but you are starting to see a top. So there are technicals at play when it comes to the greenback specifically. And remember, one of the reasons that the dollar is stalling out is simply this idea that we're under the assumption that the Fed is coming to the end of their tightening cycle. What if that's not true? What if you start to see repricing going into tomorrow's CPI report? Something to keep in mind as well. But add on to all of that, the cherry on top of a pretty rough risk Sunday is this idea of those geopolitics, what you guys were just talking about at the top of the show. Simply this idea that we were just coming off of a war in Ukraine, that largely priced in. Now we're talking about more geopolitics with China, a little bit of deja vu, and that's really creating a bid into the industrials and aerospace sector. Think your Lockheed Martins, think your Northrop Grumman's, even your Boeing's just a little bit, and that, of course, helping drive the trade as well, Danny.
Yeah, when aliens are in the conversation, who knows how we should be pricing that in? Kriti, thank you so much. Bloomberg Kriti Gupta there. Now, to that point, 3 flying objects have been downed over North America in as many days, with another reportedly spotted over a Chinese port city. U.S. fighter jets shot down objects over Alaska and Canada on Friday and Saturday, and another over Michigan yesterday, less than 10 days after a balloon was downed off the coast of Carolina. Joining us now with the latest is Nick Wadhams, who leads the team coverage for U.S. national security for Bloomberg. Nick, look, the balloon story isn't new. We know China balloons have flown over the U.S. in the past. Taiwan says they see one every month. What is new is the spate of the U.S. shooting them down. Why now? Why this sudden increase, this sudden escalation here?
Well, the Defense Department gave a convincing explanation about this yesterday, which is essentially that they've fine-tuned their radars much more. They're looking much more for objects in U.S. airspace since the incursion by that Chinese balloon now about 10 days ago. So they're picking up these objects, and then when they see that they pose a risk to civilian aviation or drift toward a sensitive military site, of which there are many scattered around the U.S., they have to make a call on whether to shoot that down. There's no indication that any of those 3 objects shot down in the last few days had any link to China, but what's clearly happening now is the U.S. is looking a lot more, scrutinizing its airspace much more closely, and we're starting to see this pattern over and over.
Do we look at this, Nick, as another step up in tensions between the U.S. and China? I was noting earlier that Terry Haynes of Pangea talked about this. There is a spike in geopolitical tensions. The markets are not pricing this in. You have a Ukraine-Russia war at a stalemate. Are we underestimating here the ramp up?
Well, you're right. It feels very much like tensions only continue to get worse. You know, we had the U.S. really going hard on the idea that this was a Chinese surveillance balloon, that it was part of a global surveillance program. China shot back and said it was a weather balloon. Then the U.S. shoots down these other objects. And then, as you know, we start to see reports in the Chinese media that there's a balloon drifting off the coast of China. And then China says that the U.S. has sent surveillance balloons So we sort of seem to be in this escalatory spiral. I mean, who knows where it's going to lead, but the two countries trading accusations over, we're not talking about hypersonics or aircraft carriers, we're talking about balloons, so it's a little bit, odd in that way, but definitely it seems to be getting worse.
Nick, really appreciate the insight there. Thank you very much. Nick Wadhams of Bloomberg joining us. Okay, so that's one risk. The other risk is headed into CPI tomorrow at 8:30. That is the number. Now, earlier today, Fed Governor Michelle Bowman said that more rate hikes may be needed to reach the central bank's inflation goal.
We are still far from achieving price stability, and I expect that it will be necessary to further tighten monetary policy to bring down inflation down toward our goal. Doing so will likely lead to subdued growth in economic activity and some softening in labor market conditions.
That was Michelle Bowman speaking earlier. So let's try and piece these two things together. Our question of the day is, what are the unidentified object risks? There's some out there that we know, there's some out there that we don't. How do we deal with that as we head into CPI tomorrow? Former Fed Reserve Governor Randy Kroszner joins us. Now, Randy, seriously, what is the risk?
Well, certainly, if the inflation print is higher than expected, people are going to get very concerned. They're hoping for a deflation of the inflationary balloon, and if that's not coming, that's one of the big risks. But even if the inflation print is pretty much within expectations or a little bit better, exactly as Governor Bowman said, it's about the labor market. The Fed is very concerned that the price increases are going to be sustained unless we really see a step down in the growth of the labor market, and that most recent jobs report suggests anything but that.
Mm-hmm. There does seem to be some gratification on this side from Powell that we have seen inflation start to come, and there haven't been cracks, at least major cracks, or any really, in the labor market. Randy, do there need to be obvious cracks in the labor market to get comfortable, to confirm that the trajectory of inflation is easing, that it is moving down?
I think that's what the Fed is looking for, and I think that's the most likely outcome. Now, some people have argued for what I've called and others have called an immaculate disinflation. That is, that we get the inflation rate to come down, that we get wage growth to come down without the job market significantly weakening. We've never seen that before. It's possible. I don't want to dismiss that possibility, but we've never seen it before. So I think it's not just about the CPI report and the other inflation reports. It's also about the labor market, because I think the Fed has made it really clear that unless they see inflation on a sustainable and sustained path down to their 2% goal, they're going to keep at it. And so I think they're going to continue to raise rates to, let's say, the mid-5s at least, and then hold it there. To make sure that inflation comes down in a sustainable way.
So, Randy, not to make it such short-termism, but if you are on the Fed and the print comes out tomorrow, what's like your worst-case scenario? That it's higher, that it slows but not as much as we're thinking, or that it slows a lot faster? Like, which is actually the worst outcome for the Fed in terms of then what their messaging has to be?
Oh, no, if it slows significantly, that's good, no matter what.
But you can make the argument, Randy, that if it slows significantly, then you have asset prices are going to rally.
Yeah, but I mean, if you really do get inflation coming down significantly and in a sustained way, that's great. But of course, it's only one data point. You never want to overreact to one data point. And certainly when I was at the Fed and Jay and his colleagues make that very clear, they don't overreact to any one data point. They want to see something that's in a sustained way. I think the most problematic outcome is if inflation is moving up in ways that they're not expecting. I think they think they're going to see less pressure on the goods side. Shelter services will gradually come down, and that they're hoping that the other services, which are really driven by the labor market, because wages are such an important part of the services sector, that comes down. But if that's not coming down, then they really have to keep at it, and they really need to see the labor market crack, and that means a recession is much more likely.
Well, the market hasn't been buying it when Powell says that rates need to remain sufficiently tight for some time. How useful is forward guidance at this point in the cycle?
Well, the markets have been not believing Jay for quite some time. This started back in July when it made it really, really clear they're going to raise rates and they're going to keep them up. And the market said, oh, we don't really think so. Then he gave that Jackson Hole speech where he shortened it and he just said one thing 8 times, which is we're going to keep at it. And they finally started to accept that a little bit. And I think you can see in the market expectations that they're getting to be a little bit closer to where the Fed is, that rates will stay above 5% for most of this year. I think it's likely that they'll stay above 5% for all of this year. One of the things that I haven't seen as much discussion of is that even when the Fed stops raising rates, when you adjust for inflation, that means real interest rates are going to be going up as inflation's coming down. So there's still continued tightening when the Fed is just keeping nominal rates constant and inflation rate is coming down. And that's where I think the recession risk increases towards the end of the year.
Yeah, Randy, I'm still looking at WIRP on the terminal, and we're still looking, if I'm reading this right, like 2 cuts by the end of this year. Does the Fed need to price that out? Do they care about what the work function is telling them?
Yeah, I think they're trying to, they're I think being pretty consistent in their messaging, and I think they will be very consistent in their actions, that they're going to keep rates up. Now, of course, if the economy falls off the cliff, there are a lot of other geopolitical things that could go on. I mean, obviously, we're talking about unidentified flying objects, and there's an enormous amount of geopolitical tension that's out there. So that could lead to a Fed pivot. But let's put that aside. Unless the economy really, really contracts and inflation really, really comes down rapidly towards the end of the year, they're going to keep at it, and they're going to hold, because they don't want to have happen what happened in the late 1970s, which is when in early 80s, when the Fed pivoted too early, and then they had to raise rates to double-digit levels in order to bring inflation down.
You mentioned that a Fed pivot could come from geopolitical tensions. What do you think that would look like, Randy? How bad does it need to get for that to be the driver?
Well, there's certainly there's a hot war going on with Russia and the Ukraine right now. I hope there's not going to be other hot wars that will come online, but one never knows. And obviously there would be an important pivot because the Fed would have to think about what are the economic consequences of significant increase in tensions, and potentially even if there is some sort of intervention somewhere. So I think those would be some of the things that they would take into account if they saw that as having a very big impact on economic activity.
Hey, Randy, before we let you go, what do you make of everyone talking about a vibe session? You feel it, you're worried about it, and we can see that in, say, the UMich numbers and the current expectations numbers, but the data's still good. And I'm not just talking about the unemployment number. Like, there are still good signs in different areas of the market. Even housing looks like it had found a bottom. What does the Fed do with something like that?
Sure, and so this is why so much of what the Fed is dealing with is the expectations issue. It's about inflation expectations, not just actual inflation, but where do people think inflation is going to be going? And that's one of the reasons why the Fed doesn't have to raise rates to double-digit levels right now, because if you look at inflation expectations, either survey-based measures or market-based measures, they haven't gotten out of control. Now, that's pretty good given how inflation kind of got out of control over the last year. It's starting to come down, and not only in the U.S., but globally. And so it's always about the expectations. It's about where people think things are going, because that's what affects behavior. That's what affects investment, consumption, savings. And so that's really what the Fed needs to focus on. So the vibe is important. It's that expectation component that's super important.
The vibe is important. Randy, so great to get your thoughts ahead of tomorrow's CPI release. Randy Kroszner there, professor at the University of Chicago Booth School and former Fed governor. Coming up, California is able to borrow more cheaply than Florida, Texas, and about half of a dozen other states who voted for Donald Trump in 2020. The key, ESG. This is Lindsay.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Tens of thousands of Israelis are protesting against government plans to reduce the power of the judiciary. This comes hours after President Isaac Herzog warned the country is on the verge of, quote, constitutional and social collapse. Demonstrators want to derail a proposal by Prime Minister Benjamin Netanyahu and allies to make it easier for the state to appoint judges and limit the Supreme Court's authority to strike down legislation. German Chancellor Olaf Scholz faces more turbulence in his coalition after a bitter Berlin state election in which all three ruling parties lost support and one crashed out of the city's parliament. The Conservative Christian Democrats, the main opposition party at the national level, emerged as the clear winner after Sunday's vote in the German capital. They beat Scholz's Social Democrats by nearly 10 points. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thank you so very much. Here's a fun fact for you. It costs more for Texas and Florida to borrow than California. This comes from his latest opinion piece for Bloomberg News editor-in-chief emeritus Matt Winkler says, quote, if socialism means state control of production, distribution, exchange of goods and services, then Florida and Texas fits the description. Bloomberg's Matt Winkler joins us now to explain. Matt, it was a really interesting piece and looked at it in a way that I hadn't been thinking about it. What's the overall thesis here? Why is Texas and Florida having to borrow at higher cost?
First, we need to acknowledge that Texas and Florida are AAA rated, so they have the highest credit rating in the market. California does not have that rating. An inferior rating, in fact. Not bad, but nowhere near as good. And California today is consistently borrowing at interest rates that are well below Florida and Texas. That, if you like, divergence widened dramatically when both Texas and Florida, the states, publicly said, we don't want any banks that are in any way favoring ESG to be underwriting our bonds. And specifically in the case of Texas, they didn't like the banks that had a view about firearms, for example, automatic weapons that have unfortunately made a mess of our schools. And so these banks have been excluded. Since that point in 22, you've seen the cost to the taxpayers of Florida and Texas go up every time they borrow compared to California.
Why? Is it because banks pulled out so there just weren't the underwriters? Like, why is it costing their states more?
Well, if you exclude, for example, JP Morgan, Citigroup, Goldman Sachs, to name three, which in the past 5 years, that's more than a third of all the underwriting in the United States of America municipal market. You're taking out a huge amount of liquidity and you're taking out distribution as well. So that is understandable why you would see rates perhaps go up dramatically at that point.
Are there other factors that we can attribute this to also?
Well, the states have different ways of treating taxes. For example, there isn't an income tax in the Florida and Texas states. So that's different from California. But even when you acknowledge these differences in taxes, you still see this dramatic widening of borrowing costs go up since 22.
And Matt, great to speak with you, Danny, here in London. It also gets back to some of these other questions about Disney, for example, in Florida, the bumping up they've had with politics there. What is the playbook, if there is one, for companies who are trying to weigh the broader ESG, their shareholder needs, and political risk that's emerging from these types of discussions and laws?
Well, it's unfortunate that companies are put in this situation because the companies are really responding to their customers mostly. If you think about Disney, largest employer in Florida, is doing things that its customers and its employees want it to do with respect to treating people with equity and inclusion, for example. And the state of Florida has definitively, cynically pushed back against, if you will, diversity and inclusion, which is something that Disney is responding to. Yeah, I mean, it's a bit cynical if you think about it this way, because Disney, as I said, is the largest employer in Florida.
Before I let you go, Matt, are the rating agencies going to catch up to this?
Well, the rating companies actually rate the states based on, their economies and so forth. So it has very little to do with social issues per se, if you like. And the states of Florida and Texas are pursuing a social agenda, literally a social agenda. They don't like commercial banks acknowledging that diversity and inclusion is, for example, part of the pursuit of excellence. They don't believe that. But there's ample evidence, by the way, the longer we live, that diversity and inclusion is part of the pursuit of excellence. So these policies by both Texas and Florida are actually regressive, and they harken back to the days when both of those states, if you remember, you were probably still alive then, I think. You were born. They had racist policies, okay? And there's a bit of nostalgia for the racism that pervaded Florida 50 years ago and the racism that pervaded Texas as well.
All right, Matt, an important conversation. Thank you so much. We appreciate always when you bring the data to us. Bloomberg Editor-in-Chief Emeritus Matt Winkler, thank you. This is Bloomberg.
Look, it's a strange start to the week for trading. We have two really big set pieces coming tomorrow in the way of CPI. Paul Donovan at UBS calls today a barren wasteland when it comes to the data reports coming in. So we are seeing European equities moving higher, about 0.9%. Volumes really low, about a third lower than they usually are at this point. I mean, why would you want to take a lot of risk, put a lot of risk on the table when those CPI numbers, yes, in the U.S. could change things up quite a bit. We're also going to get European GDP tomorrow. But in the meantime, we did have an upgrade from the European Commission to the outlook. We're seeing two-year yields in Germany's, those up about at a 2008 high. Nat gas, that is also coming in overall to this picture of a brightening outlook in Europe. We're going to talk about that outlook with Wei Li coming up at BlackRock. This is Bloomberg. It's Monday, the 13th of February. European equities bumping up higher to start the week. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
About 30 minutes ago until the close. Let's get your check on markets. European equity is moving higher by about 0.9%. Volumes are really low. Again, a lot of set pieces tomorrow that we need to be aware of. So that preventing perhaps too much volume, too much risk being put on the table. But Sharon Bell over at Goldman Sachs did say European stocks a lot more room to run given that valuations compared to American equity are still very attractive. Now, one story that continues to run, it's the German yield story. Two-year yields, those are up by about 3 basis points at a 2008 high. They really did react into those American job numbers. Here we are, though, over a week away, and we're still getting a market that's digesting the reality that perhaps inflation won't be a straight line down. We did get some European Commission figures. We'll talk about those in a minute. That did cut their inflation outlook. Finally, nat gas, that's down by about 3.5%. This is now at a September 2021 low. Alex, there's this really fascinating story from the Bloomberg team. I highly recommend it. Essentially, Europe has bought up so much stockpile of energy, of nat gas, that they're actually stuck with it. They don't want to sell it because this number is so low. They'd sell it at a loss. So Europe almost a victim of their own success in the energy story.
I know, I do love that story. It's like they did everything right, and now look what happens. All right, here in the U.S., it's a very similar theme. Volume, pretty terrible. The S&P is still up by 0.8%. The NASDAQ up over 1%. The why, though, really comes from Microsoft, which is contributing about half of the point rally that we're seeing in the NASDAQ 100. Got a couple analyst upgrades earlier in the day. They see their 2024 long-term growth forecast looking pretty good. They like the stock. Okay, so that's where we are within the equity market. Then the bond market, as Danny was saying as well, their front-end yields up by about 2 basis points. The curve continues to invert. Ira Jersey of Bloomberg Intelligence was saying that it feels like position is a lot cleaner now in the bond market headed into CPI. I think the question is, like, is this really the start of a new fundamental narrative for the markets, or is this like a calm in the eye of the storm and the hurricane tomorrow's really going to shake stuff up, Danny?
It certainly will shake stuff up. I should say we also get Euro area GDP tomorrow, but we already had an estimate come in from the European Commission for their 2023 outlook, and it is better. Look, the line is thin between recession and no recession, but for the European Commission, that line just got a bit thicker. Right over here, they previously saw growth in the Euro area at about 0.3%. They've upgraded that to 0.9. Why? It's all about energy. It's all about the improvement in that story. It also means that their inflationary forecast they were able to cut. They've cut it to under 6%. Before it was about 6.3%. But of course, that's still not positive, Alex. It's still a lot of price growth. It's still a lot for the ECB to try to wrap their arms around.
Yeah, and it's the continuing signal that we're seeing, right? It's like the data is still holding up, even though the sentiment feels really mushy, and there are still a lot of risks that everyone's then worried about. That vibe session we were talking about with Randy Krosner. So to this point, Danny, the EU Economy Commissioner Paolo Gentiloni did talk about that difficult period of growth with potentially slowing and inflation easing, but it might just be gradual, and he gave his outlook ahead.
Risks to this forecast appears to be balanced. While past risks related to pandemic and gas shortages have ebbed significantly, uncertainty remains very high also in relation to the war and to the geopolitical tensions.
Now let's get back to our question of the day in this context as we think about things in the sky. What are the unidentified object risks? What will bring things back here on ground? That's my best attempt at yet another pun. We're joined now in London by European economics reporter Jana Randau and Markets Live editor Noor Al-Ali. Jana, I want to start with you because we did have this European Commission estimate come out, revise higher growth, revise lower inflation. To that idea of what are the risks, what are the risks for that actually playing out for Europe to be able to avoid a recession?
I think we can't avoid talking about the elephant in the room, which is still energy, right? It is what's going to make or break this trend of keeping the economy resilient or potentially even helping it grow more than expected. But it's also going to make a very big impact on where inflation will actually go. And then if you spin that ahead, we need to talk about wages. We need to talk about the central bank response. And then if you look a little further out, we can talk about China, whether the reopening there is going to be inflationary or not, with all the consequences on the domestic side of things. So I'm not sure there is anything that is unidentified. What may be complicated to gauge is how all those details will basically come together and impact the economy as such.
Yes, exactly. And it's so confusing because then I look at the equity market. European stocks are up 12% this year. Nor, what are the risks then for the market? It feels like are we pricing in perfection, in which case any little thing is going to just throw the rug out from under us?
Absolutely. I think that's spot on. Precisely what's going on right now in markets. Perhaps maybe there is too much optimism, I'm afraid to say, and I am the class pessimist today, unfortunately. But, I do think that there are, some things that we have to give the European Union, the European zone credit for. The energy prices have, come down extensively from the peaks that we've seen in the last year. We were talking about a crisis just a couple of months ago, whether or not we're going to have power blackouts and all that. And so far, we've had a really good response in terms of energy stockpiling, as you were talking about, Danny, just a bit earlier. And also now the focus is now shifting, though, to the December benchmark prices for gas and whether or not those high prices then will also continue to come down. And that's a big risk as well, because it is potentially contingent on weather conditions, and no one can really predict those.
Are we complacent then, Noor?
Not to that extent. We do have a lot of, I think, parameters in the market where we are getting some positive news, and that's really informing our decisions. I mean, the hawks in the ECB, really, this is a nod to them. We've seen, we're nearly avoiding a recession in the euro area. We're still discussing whether or not it's a possibility in the U.S. You've seen China reopening, and of course, the question that Jana proposes, whether or not that's inflationary, is really a big question, because if real money, if money growth starts growing in real terms in China and production really starts going higher there, demand is going to come up, and then that's inflation coming up much higher than markets and analysts predict, and that's another issue.
Right. So, Jana, is this the kind of thing where the ECB is going to just keep having to talk hawkish until something changes and the markets just ignore it?
Well, you can bet that the ECB will talk hawkish. We just came out of a meeting where they essentially committed to another half-point interest rate increase in March, and probably also more hikes to come in the second quarter, although they were less optimistic and less confident to give any indications on the size. But what they're all saying is we need to keep going until we actually see inflation coming down. And then if you look at the Commission forecasts today, if you look at what the ECB's new forecast will likely show in March, is that inflation, yes, it's coming down a lot quicker, but it is still much too high. The Commission still has it at about three times the ECB's target this year, and whether the ECB is going to be happy with inflation around 2.5%, 3%, 3.5% maybe next year, I highly doubt it. And that's of course headline inflation. If you look at underlying inflation, that is much stickier. We're still not through the wage rounds, so we will, there's a risk that we will see wage growth picking up, and all that are things that we can't quite predict at this point in time because there are so many things that could impact it. So in that sense, I would expect a lot more hawkish language to come in the next weeks at least, and then come March, we might be a little bit more, or they will probably be a bit more comfortable with what they see.
But I do wonder how much we take the hawkishness with a grain of salt, because Christine Lagarde, we heard her say another 50 basis points, but we're data dependent. It feels like there's still that influence from the doves. How strong is it? And perhaps making that forward guidance not as strong as perhaps Madame Lagarde would want it to be.
I mean, the the gravity or the influence of the doves is certainly increasing. With every single step we're taking more toward the peak rate, whatever that is, because nobody knows, the risks of going too far get stronger, and the louder the doves are going to get. And we heard from Mario Centeno earlier this morning that he said, yes, March is still fine, but after that we need to be really careful, and we are close or getting closer to the peak. So you can already tell there is a difference in tone.
Yeah.
They are getting very cautious.
Yeah, it's going to be interesting, and you set us up perfectly for the next segment. All right, guys, thanks a lot. Jana and Nora, really appreciate it. Thank you so much for joining us. So coming up, it will be more of the question of the day. What are the unidentified object risks, and how do you wind up pricing all of that in? Wei Li, a global chief investment strategist over at BlackRock, will be joining us. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
There's a huge amount of uncertainty out there.
We're going to get some lumpy numbers.
Will annual rates continue to fall?
If we get a hotter print, how much does that really take some of the momentum out?
Instant reaction on Bloomberg Surveillance.
The data have come in stronger than expected.
Or are they literally making it up as they go?
Plus an exclusive interview with Richmond Fed President Thomas Barkett.
It just makes sense to steer more deliberately.
February 14th might have something to say about that.
Inflation in Focus, tomorrow on Bloomberg.
We really need to see inflation converging to 2% in the medium term. And the medium term is 24-25. If we are close enough to that target in our forecast, we can certainly pause this process of hiking. But let me be quite precise. What is important, our interest rate needs to converge at some point to what we call the neutral rate. And we will do it because that's the nominal anchor that we need in monetary policy. And I think we have it in sight.
That was Mario Centeno, Portugal's central bank governor, speaking exclusively to Bloomberg TV earlier today. Now let's get back to our question of the day. What are the unidentified object risks, flying or otherwise? Joining us now is Wei Li, global chief investment strategist at BlackRock. Wei, look, a lot up in the air. I'm trying a new alien pun every single block, see if it works. That one was maybe less successful. Look, a lot unknown at this moment. We have Centeno there talking about trying to get back down to 2%. I wonder our view right now of Europe, given that it has improved, given the energy story seems to get better, what are the biggest risks, identified or otherwise?
Maybe identified because it's well flagged, but if you look at inflationary dynamics in Europe, it's way above the comfort level of central bankers. Yes, now there is more talk about, at least in the near term, avoiding a recession, and the winter is milder than expected. Even Madame Lagarde is talking about potentially avoiding a recession. But given the framing of inflation fighting, and given where we are in the economic cycle, actually the more resilient economy seems to be at this point, the more potential over-tightening is needed to bring about that demand destruction in order to fight inflation that is still running way above the comfort level of central bankers. So actually, I don't think we're out of the woods with Europe yet.
What does that mean for risk assets? That doesn't sound like a good environment necessarily to be buying into.
Well, there is a bit of a disconnect between the fundamental picture and risk assets that we have seen so far this year. If you look at what risk assets are pricing in at this moment, it's pricing in recession. Oh no, it's pricing in inflation going all the way back to target. It's pricing in avoiding a recession. Not only that, actually growth picking up from here, and at the same time, central banks will be able to come to the rescue of the economy and start cutting rates later this year. It's really hard to see such a perfect combination of macro outcome. We're not saying that it's not possible, but chances of that are slim. A lot of things will have to go right for actually what has been priced in markets this year to transpire, which is why we're feeling a bit, we're prudent at this point.
So Wei, this I feel like, hi, it's Alex in New York, poses a real problem, because if you're sitting in cash and you're watching the markets continue to climb this wall of worry, you're missing out on some returns. On the flip side, if you invest now, you're kind of ignoring your medium or longer term thesis of things really rolling over. What do you do in that environment?
Well, actually, right now, if you're sitting in cash, you're getting paid almost 5% from the Treasury, which is actually somewhat attractive as a kind of a place to bunker down in as we wait for better kind of opportunities. But more broadly, it points to the importance of staying invested. So right now, yes, we see opportunities in front end of government bond market, which is as close to cash as possible. On the other side, we're also fully invested in that we see opportunities. We have been overweight high-grade credit for quite a long time. It's done extremely well, but at this moment, it's still paying you somewhat attractive levels to wait as we look at equity dynamics. So we like high-grade credit. We like emerging market assets on a relative basis versus developed market assets that are priced almost for perfection. And then if you look at some of the broader dynamics like China reopening momentum, for example, there are still opportunities, even though it's becoming quite challenging given that disconnect between fundamentals and market pricing so far this year.
Where do you see the biggest disconnect?
The disconnect, well, developed market equities in particular, if you look at what they are pricing in rate cuts and also earnings to grow at a high single digit, and at the same time inflation going back to target, that's hard to materialize, which is where we are currently underweight at the moment. But of course, when we talk about the year-to-date dynamics, momentum plays a big role, right? We're talking about a huge wall of cash on the sideline being deployed. Even in exposures like European equities, we're starting to see inflows. Like they're very under-owned exposures are starting to see traction. And in fact, what has been behind the year-to-date dynamics, yes, on the one hand, people talk about short squeeze, but we're also talking about real money FOMO inflows that have been supporting the momentum, which is also behind, in our view, this disconnect between fundamentals and also the price action so far this year.
So Wei, what drains that money out? I mean, sentiment indicators show that people still feel pessimistic, even though they're putting money to work. What's going to drain it?
Well, right now there is a huge amount of cash on the sideline, so that's starting to decrease, but we're still talking about reasonably elevated levels. So it's hard to see kind of further cash to be put on the sideline from these levels. But thinking about immediate catalysts, tomorrow's inflation print will be key to watch. If you look at last Friday's revision, it actually shows that the last 3 months of excitement about inflation, that we're out of the woods with inflation and inflation is going to fall back to target. Well, maybe we're too premature. If you look at core CPI is more persistent than the initial print. If you look at core service ex shelter is running at 5% versus the 4.5% analyzed in the first release, and even goods deflation is not as pronounced as the initial print, initial read. So all of that points to actually it's all about inflation, it's all about rate path from here, and that dictates risk sentiment at this point.
Wait, all I can say is I am very happy we had those local reports about who would be the BOJ governor. So at least perhaps that surprise, we won't have to deal with it tomorrow. It's just CPI we got to wrap our heads around. Wei, really fantastic to talk with you today. That's Wei Li, Global Chief Investment Strategist at BlackRock. This is Bloomberg. Qatari investors are set to make a formal offer to buy Manchester United in the coming days. That, according to people familiar with the matter. Joining us now to get into it is Alex Webb of Bloomberg Quick Take. Alex, first off, is this even possible? Because isn't there some competition issues? They already own a majority stake in PSG, and having another club in the Champions League. What exactly is that sort of dichotomy that would mean they can or can't actually buy Man United?
So the rules are on UEFA, that's the sort of sports governing body in Europe. You're not allowed to have teams that compete against each other in the same competition. Now, Europeans have the Champions League, that is the premier club competition. Manchester United and Paris Saint-Germain regularly compete in that competition. Now, the key thing here is which body in Qatar is going to be bidding for Man United, and the reporting suggests that it's actually a different body from the one that owns Paris Saint-Germain. So it might be that they can get it off the line. Now, clearly it'll be looked at very closely by governing bodies, but it seems like there might be a workaround.
Alex, how much would they have to pay if this went forward? Like, what's the pricing here?
I mean, the numbers that are being talked about were, in excess of £5 billion. Numbers have gone in some reporting as high as £8 billion. clearly Qatar, its intentions might be slightly different from a private equity investor. They're not necessarily looking to make a return in 3, 5, even 10 years. Whether they can afford to pay that, or will be willing to pay that, is a very different matter. Chelsea went for a sticker price of in the order of £2.5 billion. The total consideration was a little bit more by the time you took into account promised investment in the stadium. So it would be a lot more than the biggest deal we've seen so far for a football team. Now, the thing is, football teams, European football teams, tend to be a little bit cheaper than, say, NFL teams. Because they get relegated and promoted, there is a greater risk associated with them. You don't have a salary cap, so you don't have as much visibility into your future earnings as you would in US sports. So a sticker price between 5 and 8 billion would be quite remarkable.
Okay, Alex, thank you very much. Interesting stuff. That's Alex Webb of Bloomberg Quick Take. Hopefully I sounded like I kind of knew what I was talking about when it came to football and those regulations. I didn't, so thank you, Alex, for saving me there.
Own it, dude.
All right, Alex, something that I do know more about, that I'm very comfortable talking about. Let's take a look at where European markets are as we head into the close. Now, a lot of analyst action. Credit Suisse falling nearly 5%. Shares have further to fall, according to Kepler analysts. This follows their earnings last week. Their downgrade implies another 26% downside in the next 12 months. They've slashed earnings estimates, especially for wealth management, and that's where they really have to right the ship if they want to turn things around. So negative story there for Credit Suisse. Also a negative story is UK home builders. This one comes from Jonathan Bell of Deutsche Bank. So you can see all of them falling on the day a downgrade. Now, the story here, though, isn't necessarily that these are not good companies, but just that what the analysts there saw as overvalued is no longer there, saying that, look, if you have timed your entry well, congrats, you can now take a profit. But we still are looking at Crest Nichols Holding falling some 5%, Persimmon down 3.6%, Taylor Wimpey down at 2.9%, so perhaps some profit taking there. Just a few moments to go until the close, I should say, of the European session, with those home builders weighing down on the overall market. The European stocks broadly higher. This is Bloomberg.
great questions.
Just a few seconds ago until the trading day wraps up here in Europe. A positive day, a good start to the week after what was a rocky week last week, but of course a good start to the year. We're looking at the CAC 40 outperforming. That's up some 1.2%. Elsewhere, gains are mostly under 1%. Of course, the thing to keep in mind for today is that volumes just in general have been low. They're off by about a third of where they usually are at this point. A lot of risk events coming tomorrow, but let's look at the overall session because the Stoxx 600 was able to end higher, not by 1%, but just under it. 0.9% is where we currently stand. We heard from Sharon Bell over at Goldman Sachs writing today that Europe represents an opportunity. Just looking at PE ratios compared to the U.S., it is a buy. It is still undervalued. So that meant that most sectors moving into the green today, but I should say we did have a little bit more weakness when it came to the energy sector, ending flat on the day, exactly 0%. I don't think you see that often, but we did see oil waffle around today. Mostly it was lower. Some folks taking profit on that oil trade given it had rallied so much last week with Russia pulling back on supply. To the upside, travel and leisure, construction. So a lot of consumer type exposures here leading us higher besides energy, everything into the green. For some of the individual movers, I pulled out a lot of analyst changes, analyst recommendations here. That seems to be the big driver, not necessarily an earnings heavy day as we did see last week. Credit Suisse, a downgrade from Kepler, so this is going to fall another 26% this year. It's currently at just under €3. It's down 5%, Swiss francs, I should say, not euros. It's down about 5% so far today on that downgrade. They're saying that, look, overall the picture is grim following on from their earnings last week. Still a long way to go. Persimmon, another analyst action here. We had Deutsche Bank saying that basically it's fair priced. If you bought this at the right time, good for you. It's time to take a profit, and it looks like some folks are. Now to the upside, we have Saab. All of the defense names doing very well today in general. We also had some analyst action here that Saab specifically has further to go, that their story of defense, aircrafts, all of that look extremely strong, and they are undervalued following on from their earnings yesterday. So those shares up about 7.33%. Now, in terms of what we are going to be facing tomorrow when the European market reopens, it is quite a difficult day, especially in the U.S., so that could shift things up. But looking specifically here in Europe, we're going to have a NATO defense ministers meeting in Brussels. Of course, the war in Ukraine continues on, reaching that one-year mark. UK jobs data, this in focus. With the BOE, confident they're going to hiking more, but some questions there about risk, about inflation risk. Finally, TUI, we're going to get earnings from the travel company. Is that demand spending still clear from the European consumer? Is there a lot of savings that are being put to work? Is that going to start to fizzle out? And finally, we're going to get the Eurozone GDP, Alex.
Yeah, let's drill down on that. For more on the Eurozone's growth challenges and on what to expect for tomorrow, particularly in light of the European Commission's forecast, we want to get more into that. So UBS said last week that they're actually looking for a better outlook for the Eurozone, raising its GDP forecast to 0.8% for 2023 and 1% for 2024. So joining us is the individual behind the report, Reinhard Klus, UBS Chief European Economist, joins us now. Reinhard, thank you for joining us. We appreciate it. What are you expecting from tomorrow's numbers for fourth quarter GDP? I appreciate that they're backward looking, but that's going to set us up for this year. What are you looking for?
So we do expect a growth rate of 0.1% quarter-on-quarter, 1.9% year-over-year. The preliminary data for the fourth quarter were already reported 2 weeks ago with exactly these numbers, so we do expect that these growth rates will be confirmed tomorrow. So this means very modest growth in the Eurozone towards the end of last year, which is not great, but it's a lot better than what we expected last fall.
How much does the better growth outlook potentially force a policy error from the ECB if it means that they can be more aggressive? Is that a risk?
Yeah, it will certainly give the ECB more confidence to pull through its monetary policy tightening. The broader issue is that while inflation numbers have peaked, We're now at 8.5% and will come lower over the next couple of quarters. What the ECB wants to see is really a fundamental improvement in the underlying inflation environment. So core inflation coming lower, inflation expectations coming lower. Also, they want to be clear that wage dynamics are under control and not creating second-round effects. So I think against all of this, it does actually make sense for the ECB to remain on the hawkish side for now, and stronger growth helps. I would also point out that the ECB greatly underestimated inflation over the past year, so its credibility has been dented, and whenever credibility has been dented, unfortunately as a central bank you need to react somewhat more forcefully than otherwise.
Perhaps that answers my next question, perhaps not, of what's the rush? The Bank of Canada, for example, clearly said, Macklem, the BOC chief there, saying we don't want to keep hiking until we hit 2%, because by that point perhaps we've overdone it. We need to have this period of wait and see. So what is the rush for the ECB that they can't afford, or at least they think they can't afford, to pull back on things, wait and see how it shakes out?
Yeah, so first of all, again, inflation has overshot the inflation target by a multiple. I mean, we peaked at 10.6% a couple of months ago. The inflation target is 2%, so that's quite an embarrassment for a central bank. And the ECB is concerned over second-round effects. So as inflation expectations are now rising, as wages are rising as well, the ECB is concerned that this is not just a one-off problem, but that it will perpetuate the problem so that inflation will remain elevated over the next couple of years, and in this sort of environment they want to be quite firm.
Reinhard, I want to dig into the growth part of it a little bit more. I understand what we're expecting tomorrow, but I'm really confused as to what you make of German growth right now, because in the European Commission report, German growth just didn't hold up, and I just don't get how the Eurozone economy can hold up without Germany really accelerating.
Yeah, thank you. So when we upgraded our Eurozone GDP numbers, we also raised our German numbers. Germany was the country we were most concerned about in the fall because it's very high dependence on Russian energy, also because of the large manufacturing sector, a couple of other problems as well. So we were quite concerned about German growth being very, very weak. Now, at the moment, we still do expect a technical recession in Germany in the fourth quarter of last year and the first quarter of this year. But nevertheless, now that the energy situation has improved a great deal, actually the sigh of relief that is coming out of Germany is certainly stronger than elsewhere. We do expect the German growth to develop a bit more favorably than we thought a couple of months ago, but the situation in France and Spain should be better than in Germany.
Where's the European Commission also seeing that improved outlook? We were talking just in the break about those figures, and you were saying that their view for next year on growth is perhaps a little too optimistic. What do you think about what they're seeing? I think about 1.5% growth for 2024 in Europe?
Correct. So for this year, they do forecast 0.9, which is very much in line with our own forecast at 0.8. But for next year, 1.5. We're at 1. So the reason why we were a bit more cautious was that we still have a lot of monetary policy tightening in the pipeline. So interest rates are, higher, financial conditions are tightening. Also, U.S. economists in the U.S. Still expect a recession to ensue over the course of this year. So this will also mean some headwinds for European growth. So against this background, we maintain a bit more of a cautious stance.
What's your take on the UK? As Jane was pointing out in the calendar, tomorrow we get the wage data from the UK, then we get inflation reading on Wednesday. What are you looking for?
So we do expect that the UK will suffer a recession. I mean, that was, our opinion for quite some time. So there are additional headwinds to the UK. The situation around energy is equally difficult as elsewhere, but also the fiscal stance is more restrictive. The Bank of England has done a lot of tightening. Also the B word, Brexit, yes, that still plays a role as well. The strike action that we see at the moment would certainly be bad for economic activity. So against this background, we're more cautious still on the UK than on most countries in the Eurozone.
How are you thinking about strikes and that feeding into wage growth? How does that factor into your calculations?
Yeah, absolutely. I mean, employees have suffered a major loss in purchase power over the past year. It's true that in Europe,
Wage growth is now above 3%, so that's actually decent. But if you factor in very high rates of inflation, there has been a very significant loss in purchase power over the past year. And of course, employees want to be compensated. This is why the wage round is actually quite aggressive. The unions go into these negotiations with a lot of resolve. They can do that because labor markets remain relatively tight. So from an inflation and monetary policy perspective, we are conscious that elevated wage growth could certainly lead to second round effects, which would then, as I said already, perpetuate the inflation problem a bit. And central banks have to react to this.
Yeah, and it's really difficult to see an end to it. The negotiations don't seem like they're moving along at all. Reinhard, thank you so much for joining us today. Reinhard Klooster, UBS Chief European Economist. Now let's take a quick look at where European equities are settling. I have to say, nothing like what we're seeing in the NASDAQ. Alex, I know you flagged this at the beginning of the show, up more than 1.3%. So maybe in context of that, I mean, gains aren't too big here. The CAC Quarante, though, that is up some 1%. DAX up about 0.5%, with the FTSE 100 as we gear up for that data, the wage data we were just discussing, up about 0.8%, Alex.
All right, I'm going to be talking about this, the rally in the equity market, as well as what to do with the inflation data out tomorrow and here in the U.S. as well. Tune in to Bloomberg Radio, the cable, at 5 p.m. London and 12 p.m. New York, top of the hour, Bloomberg DAB digital radio. Also check it out on anywhere you get your spodcast. What's a spodcast? A podcast like Spotify and Apple. I want a spodcast. All right, coming up, more on tomorrow's U.S. CPI data, plus the BOJ. We're going to look at what all this means for the FX market with Kamal Sharma of Bank of America. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Bloomberg has learned Turkish officials are considering extending a closure of the Istanbul stock market past Wednesday. Turkey began collecting blood samples to identify the victims of the 2 earthquakes that struck the country's southeast a week ago. The death toll mounting to nearly 37,000 people in Turkey and neighboring Syria. A Turkish business group estimates that the economic losses from the earthquakes could reach $84 billion. Today, an International Monetary Fund mission will start talks with Ukrainian officials as the fund weighs a multi-year aid package worth as much as $16 billion to provide a catalyst for more financial aid. On Friday, Russia launched its biggest barrage of missile attacks so far this year as President Volodymyr Zelensky seeks more weapons to fend off the invasion. The European Union is getting ready to slap Russia with another round of sanctions. The EU's executive arm will propose export measures aimed at heavy vehicles, including trucks and machines normally used